All right, today I'd like to talk about the Powell speech and what's next. Okay, Powell last week, he talked about the rates and the U.S. market. What do you think about it? And I'd like to review what he spoke about and what's next. That's the most important thing, because what his speech, you can read it there, but what does it mean? And what's going to happen next? I think that is also very, very crucial, right? So we are facing a situation where the Fed thinks inflation is set to drop, but the speed of drop is slow due to lag factor. They have been saying, inflation, yeah, it's rising, but it's already working. What we have done is working. But due to the lag factor, we are not seeing a drop as fast as we want. But they do acknowledge that it has dropped since they started this. But there are concerns that this inflation could rise further. But this is the overall what they think. Okay. Now, in reality, inflation is proving to be stickier at current levels, and Treasury yields have been surging. Okay, we have seen that. The surge in yields is due to a belief that interest rates could go higher than expected. Okay, because people are dumping the current rate ones and buying those with high interest rates, and the dumping is causing that surge in the yields, right? So what happened was the 10-year bond yield broke the high of 4.887 recorded early October, okay, this month, to a new high of 5%. And the move up in yield is also undoubtedly aided by the Gaza-Israel war and its potential escalation involving more countries. This is what's happening. People worried about that. Yeah, so this surge here is definitely not good news for the US stock market, not at all. Okay, if you look into this, right, the next here, this is the US government bond 10-year yield. Okay, that's why it hit the 5% mark right over here. Now it came down and then push up. So at the same time, this push up caused a lot of jitters in the S&P 500. This is the S&P 500 chart, and you can see it coming down right over here. And if you remember, we were calling for the shorts right about this area, right? And you can see that happening because we were looking at the yields, and the yields are just not showing any signs that they are ready to come down as yet from a technical viewpoint, right? So as such, Powell's speech on Friday was crucial for confirmation and classification on how officials view both current conditions and longer-term trends. Right, the key question is, whenever Powell speaks, right, what is the peak rate? Everybody wants to know. And the next part is how long rates need to stay this high to get inflation back to the 2% target. They have been adamant, even in the last speech, Powell has said that their target is still 2%. They're not willing to accept anything higher than 2%. Okay, so the primary message that he conveyed during his statement and Q&A was that Fed is likely to keep rates high for a longer period of time. And the point here, this is the part where everybody wants to know, right? Because, throughout the whole period, we had some thinking, the market is actually calling Fed bluff. But here, he reiterates that another rate hike is possible if economic data forces the Fed to take action. This is something that people looked at it and said, oh, it's not good over there. And that's one of the cause why we have seen the yields are also going up, right? Because this statement says it, okay? He said, we are attentive to recent data showing that the resilience of economic growth and demand for labor, additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing. Okay, because the non-farm, we saw a surprise there, could put further progress on inflation at risk and could warrant further tightening of monetary policy. I think the evidence is not that the policy is too tight right now. Okay, see this part over here? It's not tight. So that's the reason why another rate hike is possible. Now, if you look at the next part, he says this: in any case, inflation is still too high. Okay, so they have acknowledged it came down. Right now, I said it's still too high. And a few months of good data on the beginning of what it will take to build confidence that inflation is moving down sustainably towards our goal. Okay, it has moved down. Earlier reports, he said it has moved down. But right now, he has changed that part of it a bit. And that's one of the cause, we are seeing right now. We cannot yet know how long these low readings will persist. These lower readings will persist, or where inflation will settle over the coming quarters. While the path is unlikely to be bumpy and take some time, my colleagues and I are united in commitment to bring inflation down sustainably to 2%. This is what he said again. Okay, so if you look at this, right, the moment he said that, I checked the rate hike probability by CME. It's showing a 99.9% no rate hike in November and 80.1% in December. They're still saying no. Okay, one of the reasons is also why we're not looking into that at the current moment, because the other FOMC members, right, when they updated the market, they did say that this high interest rates, the yields, high yields, coupled with the premiums, that is already putting the brakes on in the inflation, and that's going to help already. We don't need to raise rates further because of the risk of overdoing it. Okay, those are one of the reasons why we're not seeing that and this. But then again, this thing can change, right? Anytime. Now, if you look at over here, it's written here 99.9%, and that's 80.1% no hike chance again. Now, if you look down, and you can see that, hey, only when here. So that means rate cut could only be seen in June 2024. Okay, June 2024 only. You see that probability for maintaining that jumps over here. That is this possibility. So, but then again, we can't say anything. It can change anytime, because Fed has always said that their rate decision is data dependent. All the time they've been saying that. So we know for the fact right now there's possibly one rate hike, sorry. And then the Fed is going to maintain for until June. So this is what we know right now, given that situation. And from that, you can do your planning, what's next, what to do. Okay, so with this kind of developments, right, you can still expect the US dollars to move up a bit, and then after that down, because right now, when it comes to the charts, I'll explain to you in a short while. But the key point here is this last one right over here, is that we have to wait for this inflation news. And if it comes out as per, it comes out higher than expected, we already seen that there's a possibility of that happening, then November, probably no rate hike, but December, that probability might change. Okay, so we will have to see, because this PCE is the widely preferred inflation measure. And if the PCE is also showing that there's an increase, and things might really change. Okay, if it doesn't, what's going to happen? Probably we're going to see the yield going higher than 5%. And when that happens, that you will have the S&P 500 actually dropping even more. Okay, to go to our lows before moving up again. Okay, so these are the things, just wait a bit, and then we know how to deal with it. But at least you have this time frame until June next year. So if there's any huge correction in the market, that can happen between now until June. Okay, in the US stock market. Right, so these are the things that you should look out for. And with this also, the risk inside the market, then the gold can continue to go up before correcting down again, which also tells us right now there is a bigger room to move for the gold. Probably we'll be seeing gold also breaking the 2,000 mark, moving up. Later on when it comes to the chart, I also explained that there's this possibility of gold moving to above 2,000. And when it comes to the chart, I'll tell you where exactly that level it may go to. Okay, so with that, that's the fundamental report for today.